Welcome to the first OJM webinar of 2016. Today we're going to be talking about the 2016 market outlook. We're also going to spend a little time reviewing 2015 and some of our views as we move forward beyond 2016 over the next 3 to 5 years. With me today I have the OJM Wealth Management team, myself, Bob Peelman, the Director of Wealth Management, along with my colleagues Andrew Taylor and Adam Braunscheidel. We'll walk you through our viewpoints as we look into 2016. We start with disclaimers that everyone loves, the legal disclaimers. OJM materials, these are free to all attendees. We're very proud of the publications, the books that we've written on financial topics as it relates to both physicians and business owners. At the end of the presentation, we'll have a slide for you to find out how you can get a free copy of one of our books. As I mentioned, today's presentation, we're going to start with a look back at 2015. A lot of talk about equities and the disappointing returns that we've experienced in 2015 in the equity markets, specifically oil and China, which I know is very topical as of even today. We're going to talk about global investing, whether or not it makes sense to continue staying the course globally, or is this a period of time where you may want to think about cutting your losses. And finally, we'll conclude with our asset class view and how we at OJM position our portfolios and what our thinking is behind that positioning. So I'd like to start, and I will transition to my colleague Adam Braunscheidel, who will walk through 2015 last year in review.
Thank you very much, Bob. So as Bob mentioned, 2015 was certainly met with many challenges, both domestically and globally. Among the major global stock markets, U.S. stocks were the best performer. However, that's really faint praise, given large cap stocks were only up 1.3%. Developed international stocks finished the year down slightly, very similar to last year. The theme there was the stronger U.S. dollar eroding the returns for U.S. dollar-based investors. Certainly many concerns coming out of China over slowing economic growth. Also, they were impacted by the stronger U.S. dollar. Really, globally, outside of the United States, returns were impacted by the stronger U.S. dollar. Really, China results helped result in EM stocks falling close to 16%, which happens to be the worst return since 2011. Core bonds gained just 0.3%, which happens to be the fourth worst year since 40 years ago, when the index inception came about. And finally, high-yield bonds were far worse than your core bond holdings, finishing close down to 5%, which happens to be the fifth negative year in the 30-year history of the asset class. So to continue on here, last year, just a couple other notes. Last year was the first time since 2001 that no single asset class posted double-digit returns. That includes stocks, bonds, commodities, currencies, etc. The S&P 500, being the best performing major global stock market, was only up the 1.3% return. However, if you look at what drove or what attributions drove those returns, it was really a handful of internet technology-based stocks. And really the phrase that was coined this past year was FANG, because those four were Facebook, Amazon, Netflix, and Google. The U.S. dollar, like we mentioned, really hurt returns for U.S. investors, as the U.S. dollar finished up close to 10%, following a 12% rise in 2014. On the oil commodity front, we all know oil has really been beaten up over the last couple of years. Really, they were the worst performing area of the overall global stock market, down around 25 to 30% for the year. We saw oil prices hit 11-year lows in December, falling about 30% for the year after plunging 50%. And we'll look at a chart of oil here in a few slides. And finally, the Fed raised rates for the first time in nearly a decade in their December meetings. So moving on, here's just a chart just to show you in terms of the Fed making that interest rate move. They felt that the economic statistics were strong enough in December to initiate their long anticipated first interest rate rise. This is coming since 2006. Really, it's been about around zero since late 2008, since the financial crisis. On the 16th, they raised the Fed funds rate by 25 basis points to a target of 25 to 50 basis points. Really, I think globally investors had been expecting this, and actually global stock markets signaled really an immediate approval by moving higher on the day. However, since then, the markets has sold off slightly. So we continue to watch in terms of through this year. The consensus seems to be potential rate increases. However, they just actually met yesterday and did not increase rates. So we continue to watch that to see how the Fed moves along throughout the year. Moving on, touching back on the FANG portfolio, as we're calling it, in terms of how they drove gains in 2015. As you can see, the returns for those four stocks all above 30+%. Facebook 34%, Amazon 117%, Netflix 134%, and Google 44%. You can see how that really drove the overall performance of the S&P 500 in the United States markets. Really, to take that a step further, most of these companies are in that growth slant style box, and growth actually outperformed value by 900 basis points, or 9% in 2015. So pretty drastic difference in terms of what you owned. The next slide here we want to look at is just kind of a graphical depiction of how far oil has fallen. It's down over 70% over the past 2 years, which has put some pressure on some companies inside, not just inside the United States, but globally. It's obviously helped the consumer as we see oil pretty much nationally under $2 a barrel. I've even seen stories of under $1 a barrel in different areas of the United States. So it certainly helped the consumer, but really has hurt businesses that operate in that energy sector. And with that recap of 2015, we're going to now take a look at, okay, where we know where we've been, where are things heading in 2016 in terms of the global markets. And I'll pass it over to Andy Taylor.
So thanks, Adam. We wanted to spend a few minutes on global investing. The question we're consistently being asked by our clients is, should we continue to invest internationally? For the last 5 years, U.S. markets have outperformed developed international markets. 3 of the past 4 years, the U.S. has outperformed emerging. You add in the fact that those asset classes have added a tremendous amount of volatility to portfolios without beneficial incremental return. It's reasonable for an intelligent person to ask, well, why would I continue to invest internationally, and should I continue to do this in the future? So we're going to briefly address our position, which, by the way, is going to be that you should continue to have assets allocated to foreign investments. We're going to focus on a few points. We'll touch on market history and investor psychology. We'll take a look at fundamentals, and we'll take a look at current valuations to help you understand how we formulated our opinion. So if we transition to the next slide, we'll take a look at the recent outperformance of U.S. stocks. And today feels a whole lot like 2001. I'm actually getting asked the exact same questions today that I was getting asked in that period of time. There was significant outperformance in U.S. stocks from 95 to 2001, and then suddenly the tide turned, and you can see developed international and EM really drove portfolios for the next 5 to 6 years. You may have seen studies from Dalbar and from other independent research companies that have mentioned returns of the average investors in the range of 2 to 3% annually. And the reason for that, most investors suffer from overconfidence in their ability to predict future events. You know, intelligent people react to news, but the problem when it comes to financial markets, that news is immediately priced in. So naturally they're responding too late. And you have to ask yourself, well, when does a stock do well? Well, it's not necessarily tremendous performance, but it's outperformance relative to expectations. And this is the exact kind of scenario that we're looking at with foreign investments. Expectations couldn't possibly be much lower. So, you know, one concept to keep in mind, the Warren Buffett philosophy, you know, when there's blood in the streets, that's the time to invest. And, you know, in many ways, that's what we're looking at with foreign investments. So as we transition to our next slide, the case for global equity exposure. If you take a look back at 2011 to 2015, this is just another way to illustrate the outperformance of U.S. investments. Now, we're not about to predict a short-term bottom for foreign stocks. No one can consistently do that. But when you are building a strategy for the next 5 years, we certainly feel good about the probability of outperformance by international investments. The next few slides will show why we feel confident about that strategy, and also why we feel like there's a very large disconnect between current pricing and where foreign investments should presently be priced. So we're taking a look here at economic growth, you know, in emerging markets relative to the developed markets. You know, there are a lot of great things going on currently in India. Whether or not you believe some of the numbers that's being released by the Chinese government, the fact is they have a rapidly growing middle class with a tremendous rates of consumption and humongous purchasing power in the second largest economy in the world. So you have an asset class that hasn't experienced growth over the course of the last 10 years from a stock market perspective, but yet growth rates within that asset class are anywhere from 2 to 3 times what we're seeing in developed economies. If we transition to Europe, European stocks are trading at very attractive valuations. Now, we don't necessarily have time to get into some of the other factors that are potential catalysts for Europe, such as the impact of currency and cheap oil. But when you look historically at any asset class, and any stock for that matter, there is plenty of history to support the fact that very inexpensive companies tend to dramatically outperform those that are expensive. And the same story with emerging markets. Valuations are at all-time lows relative to U.S. stocks. Now, EM tends to trade at a discount, but the chart that you're looking at in front of you is relative to what we've seen over the course of the last 30-plus years, and EM is about as inexpensive as you could possibly imagine, and the reason being is the blood in the street factor. So that wraps up our outlook on global investing. At this point, I'm going to transition back to Bob Peelman for the final piece of our presentation.
Thanks, Adam. Thanks, Andy. Great information. So as you can see, we're in an interesting period of time where it's difficult to stay the course. It's difficult to think about the long term. It's difficult to review your portfolio in its totality because of a lot of the short-term news, a lot of what's happening in oil, emerging markets. And so we think it's important to pause to review where we've been in 2015, dive a little bit deeper into our thoughts, as Andy did, about global investing. And then, big picture, how do we build these portfolios? How do we view each of these asset classes? So I want to spend a moment on this slide, our view of a few of our asset classes that are in our portfolios today. U.S. equities, U.S. stocks. We view right now our portfolios have a underweighted position to U.S. stocks. A couple main reasons for that. We feel profit margins are currently at record highs, and our viewpoint is they're unsustainable, at least in the short term. And we also look at it in short term for us as 5 years. So we view everything either strategically with a 30-year outlook, but we put a 5-year overlay on that to position our portfolios to take advantage of these short-term economic moves. Stock prices are very much high. The expected returns based on these current valuation levels are not encouraging. And so if you're a value investor, you would look at U.S. stocks and say, we've made a lot of money over the last several years if you were just a U.S. stock holder. Took a lot of risk for it. But at the same time, we now view that as an area of what is our expected return of that asset class moving forward, and we would view it in the low single digits with much more volatility on the horizon. So the rising interest rate environment is a big risk to portfolios, and if we remember back to Finance 101 classes and think about how the price of bonds work, they are inverse to interest rates. So in a rising interest rate environment, you could expect lower returns for your core bond holdings over the next 5 years. As the Fed begins to raise rates, the price of your bonds are going to come down, and it may make sense to have some absolute return-oriented fixed income holdings, which can help better manage that interest rate sensitivity, and that's something we have certainly added to our portfolios over the last 12 to 18 months. International equities, we view it as an opportunity. Last week, the European Central Bank came out and maintained that they're going to consistently keep the rates low for now, the possibility of some quantitative easing. So very much they're in a situation which we were in a few years ago, which you can debate whether or not these are going to be long-term positives for the economy in Europe, but they're certainly short-term positives for the equity markets. And so there's attractive valuations, both emerging and developed, and we view the probability as high that you're going to see earnings growth be much higher at these depressed levels. So again, as we position our portfolios, we want to be weighted a little bit more towards those international opportunities as we see a higher opportunity over the next 5 years to generate the returns that our clients are asking for. Alternative strategies, again, is an opportunity. We sort of view alternatives as a hybrid between stocks and bonds, trying to give us a yield better than core bond holdings, but at the same time offer a volatility much lower than U.S. stocks. So that risk-adjusted return potential is going to be very, very important to our clients when it comes to their overall risk profile that they're willing to accept and achieve the returns that they want to achieve. So those strategies are going to offer a very low correlated asset class to the overall pie. And that's one of the reasons we have weighted significantly to those holdings. So as we view how we position our portfolios, I mentioned previously U.S. stocks, we currently have at an underweighting. We certainly own them primarily. We could be wrong. Obviously, the market can continue to drive the S&P 500 higher for a variety of reasons that are out of asset managers' control, whether it be more intervention from the Fed in some way, and to keep some of these asset classes moving forward. But also because it's important to have that asset class long term, and the way that we do it with a lot of our clients, we think we can generate some additional return or alpha from that asset class that'll help to outperform even those low single-digit returns if possible. Again, we're going to be fully weighted to European and emerging stocks for all the reasons that both Andy explained and I briefly explained just now. Fixed income, we're underweight significantly for most of our clients, the U.S. core fixed income. That's simply a function of our expectations of rates over the next few years and what types of return we can get from that asset class. I'm often asked, why would we own that asset class at all if we view the return to be low? And I think it comes down to risk reduction and flight to safety. Certainly, if you look at days where the market pulls back significantly, you'll see the way the 10-year Treasury moves and how your fixed income holdings should move in your portfolio behaves in a way that it's going to be there to reduce risk. So we still want to own the asset class at a certain percentage, but not the way that we would traditionally do so. But we do allocate to alternative fixed income to generate some yield and to alternative investments. And we think those are very important components of a portfolio and have helped our clients drive a lot of performance. If we're looking at our economic scenarios, I won't go through all three, but the base case for us is a continued sort of plow horse economy, a moderate economic recovery. with no major crisis on the horizon financially speaking. Certainly there's 5% a black swan that we can't, 5% of risk that we can't diversify away, whether it be geopolitically or otherwise. But from the economic standpoint, a normal recession is likely within the next 5 years, which is always within the realm of how we model those. And we assume GDP growth and interest rates start to normalize toward the end of that 5-year horizon. That's the bulk of the presentation. I do want to close with just reminding our current clients, but also prospective clients, how OJM works with clients. We are a multidisciplinary and multi-specialty financial planning firm with experts in all of the areas you see here: asset protection, tax, corporate structure, benefit planning, retirement planning, insurance, and then what we do specifically here, today's team, in wealth management, which is building your portfolio to work with all of these other areas in your financial plan. As I mentioned, we're a fee-based consulting firm. We've got a little over 1,000 clients in 48 states, multi-specialty, multidisciplinary, and we do offer our services both on the personal and the corporate planning side. I want to pause for a moment to see our team's contact information. As I mentioned, my name is Bob Peelman. I'm the Director of Wealth Management here at OJM. Also, we have 2 of our wealth advisors that have presented today, Andrew Taylor and Adam Braunscheidel. You can see our contact information below. If you've got a specific question for one of the team members, please feel free to reach out. And finally, if what you've heard today has piqued your interest about what we do, how we do it at OJM, feel free to receive a copy of one of the 2 books that we have currently, which is our Fortune Building for Business Owners and Entrepreneurs, or if you are a physician, For Doctors Only, which is a great read that's specific to your profession, as well as how financial planning relates to that. Free consultation is another way to reach out to us. Certainly contact our team. We're happy to have a free consultation. To receive your free book, I should mention, or your ebook Kindle, for your ebook, ebook version for your Kindle or iPad, you can visit www.ojmbookstore.com and use the promotional code you see below there, WEB0116 at checkout. Again, thank you for your time. We look forward to a great 2016. And if you have any questions, please feel free to contact us at the number below, our OJM Wealth Management team.